Hello again, everyone. It is Thursday, October 21st, 2021. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my 5 most important data series, models, and charts that I think are the most important right now and are going to have the most directional influence on the stock market over the next 1 to several weeks. Let's begin. Number 1, market internals. The Asbury 6 is positive as of October the 14th. Those who track us, those who subscribe to our free biweekly newsletter, those who are clients of ours, know that the Asbury 6 is a quantitative model that is meant to indicate what the day-to-day internal condition of the stock market is. I look at the Asbury 6 as being similar to when you go into the doctor's office for an office visit. He always does those 5 or 6 things in the beginning over and over again so he can establish your baseline health, and then he can go from there. So where the doctor is going to check your pulse, he's going to check your blood pressure, he's going to listen to your heart and lungs, he may check your reflexes. The Asbury 6 is checking different aspects of the market, and not by accident, only one, the rate of change in the S&P 500, has to do with the price of a stock or the price of an index. And we did that on purpose. The market has changed over the past 5 to 10 years where there's a lot of day-to-day noise that if you spend too much time looking at the S&P 500, it could really misdirect you as to what's going on. So although I still want to know what's going on in the S&P 500, obviously that's how we get paid, by whether the market goes up or down and how we're invested. Those other 5 are what I would call secondary indicators that aren't going to be jerked around, so to speak, by the day-to-day gyrations in the stock market. We have indicators like corporate bond spreads, investor asset flows, volume, breadth. So the last time that I was with you in your Daily 5, it was actually on September the 20th. And the Asbury 6 at that time, it was negative. It was negative since September the 14th. And that meant, for us, that meant risk off. We're starting to tighten stops. We're starting to maybe look at what's underperforming in portfolios and start to call those things. Start to reduce our stock market exposure. Well, since then, we've turned back to the positive on October the 14th. So that means that the internal condition of the market is favorable for more strength. We've been to the doctor and we've gone through those 6 things, and the market is on a near-term tactical basis, it's healthy and strong. 4 or more metrics in either direction, either positive or negative, indicate a signal in the Asbury 6. So number 2, now that we know that the internal condition of the stock market is good in terms of a tactical basis, next thing we want to know is where the levels are. So we can match up the levels with the internals because they do have a lot to do with each other. So for this, we go to a chart of the S&P 500 since the beginning of the year. And the first thing that really jumps out, at least at me, is just how closely the market has stayed on top of the 50-day moving average. It's been Pavlovian in terms of ring the bell, go to the 50-day moving average and buy the market. You can see that there were 9 tests of the 50-day moving average this year, successful tests, up until we broke down through there middle of October, latter part of October, and we stayed underneath the 50-day moving average for almost a month. This, in combination with our correction protection model, which is another tactical model that we have at Asbury Research, and the Asbury 6, told me we were in a correction. I didn't know how deep it was going to be. Nobody knows that. It hasn't happened yet, but it did tell us that we were in a corrective period and we should kind of get our defense on the field, so to speak. Well, that has changed. The Asbury 6 went back to risk on right here where I'm pointing the day before it rose back up above the 50-day moving average. So now we're back up above the 50. And if you take a look at this little action right while we were underneath the 50, that's a chart pattern. It's an inverse head and shoulders pattern. And that actually targets a move up to 45.75, which is only about 30 points higher than where we are. But it does tell us that technical analysis is pointing towards fresh all-time highs. Tactical support is now back to the 50-day moving average, 44.43. It's about 2% underneath where the market is right now. Up above there, the tactical trend stays intact. Major support is down here at 42.38 to 41.83. The latter of those being this orange line. It's a 200-day moving average. That's about 8% below the market. Number 3, our Asbury 6 tells us when to be invested. So now that we know we should be invested now, according to the Asbury 6, the next question is where to be invested. What do you buy? Ideally, we are in the market during risk-on periods as identified by our Asbury 6. And then while we are risk-on, we are in the places in the market that are outperforming. So kind of making hay while the sun shines. While the market is good, internals are good, we're choosing the places in the market that are likely to outperform the S&P 500 so we can pick up as much performance as we can when things are good. One of the ways we do that is with our SEAF model. SEAF stands for Sector ETF Asset Flows. And we built this model about 5 or 6 years ago. It's unique in the sense that it's not measuring performance. It is measuring asset flows in between these 11 sector spiders in 3 different time frames: on a trading time frame, on a tactical time frame, and on a strategic, which is weekly, monthly, and quarterly. From there, we are looking for the biggest percentage change in assets in and in assets out in all 3 time frames. So that kind of gets us one step ahead of price. We're actually watching the money flow and we're acting on that rather than waiting for the performance to come, which is typically as a result of the money flow. So getting to the signals, this SEAF model went overweight energy on 9/16. It is still overweight energy. Since then, XLE has risen by 22%, and it's outperformed the S&P by 19%. So it's done quite well thus far. And then financials is a newer one since 10/7. It's only about 2 weeks old, this particular signal. And so far, XLF has risen by 4%. This is where the money is going in the sector space. The flip side of that is we want to stay away from those sectors where the money is coming from. And right now, healthcare is where the money is coming from since October 7th. So we're avoiding healthcare and we are buying energy and financials. The next 2 are strategic in nature. Strategic it's quarterly for us. That's the trend we're trying to catch. So let's look at 2 of these indications that are kind of looking out through the end of the year, maybe the beginning of next year. The first one is the 13-week rate of change in the S&P 500. So we've got S&P weekly up top on this chart going back to mid-2018, and it's 13-week or quarterly rate of change down on the bottom. The red highlights show when there was a negative 13-week rate of change, and that was from October 2018 to February 2019. That was a corrective period. The other one was from February to May of 2020. That was another corrective period. The rest of this time, 13-week rate of change has been positive in the S&P 500. The other nuance to this chart, which is where I'm going here, is when that trend is tested as it was in May of 2019, October of 2019, and October of 2020, if it's tested and it turns back up, these are usually really good places to buy the market. Start to put some sideline money to work because they tend to be bottoms. You can see all of these three turned out to be bottoms. This does not tell fortunes or see the future. It's telling you where the momentum is. And you can see right now, through October 8th, we've gone down and kissed the zero line from above again, and we're turning higher. That doesn't tell me what's going to happen. You can't go to the bank with this, but this does tell us that this is the likely place for this trend to resume, and if it's still valid, and we have some very good risk reward here, which would be the lows of the recent correction. So that's the first strategic one I want to show you today. The second one has to do with the relative performance of stocks versus bonds. And here it is. We've got SPY up here, which is the S&P 500 ETF up top since 2021, since the beginning of the year. And down here we have the relative performance of SPY versus AGG or AG. That is the ETF for the aggregate bond index. And what this shows, and we have a 63-day moving average here again, because this is a strategic metric for us, and 63 days is one business quarter. So what we see here is that we have been in a 63-day trend of relative outperformance by SPY versus AG since the beginning of the year, and 3 times when that trend was tested, Jan 29, June 18, July 19, they turned out to be tactical buying opportunities here. Now we've got this most recently, this period between September 17th and October 6th, where AG started to outperform SPY. That's typically what happens when the market is either in a correction or in a bear market, the stock market that is. But you can see since October 7th, we have turned higher again. So this is another strategic indication to me that has historically been positive for the US stock market, that stocks are outperforming bonds again. So typically my job is to keep my clients apprised of bad things coming down the pike that maybe they can't see. And I'm usually very aware of that and careful. Right now, this to me, it looks like a low risk spot for sideline money to go back into the market. The strategic metrics we look at are good. Our Asbury 6 is positive, and we're going into some seasonal strength here between now and the first part of January. So that's your daily 5 for today. Thanks for watching. If you like our approach to the markets, I invite you to visit www.asburyresearch.com and feel free to reach out for us for more information. Thanks again. We'll see you at the next one.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.